Good afternoon. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the major market indices. We're going to look at the NASDAQ Composite, the Dow Jones, the S&P 500, and the Russell 2000. Once we finish looking at the markets, we'll also take a look at the U.S. dollar. We'll look at a few commodities like gold, oil, and silver, and we'll also take a quick look into cryptocurrencies to see how everything's behaving as far as the entire universe of equities that we could kind of trade and invest in. And then we'll move on to chart requests. If anyone in here has a chart they want me to look at, feel free to type it into the chat tab. I'd be more than happy to help you out and take a look at whatever you have a question on, or whether it's a pattern that you want, or whether it's a stock you're trying to get in or out of. Anything of that nature, I'd be more than happy to help you out. If you like what you see here, and you haven't followed me yet, you can always follow me on Twitter at StockDarts. You can visit these You can watch these videos on YouTube under the same name, Stock Darts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, earnings trades ideas, all kinds of stuff, as well as reposting these Wednesday market reviews as well. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY. As you can see, we are very near all-time highs yet again. The market has not really done much since the end of April. Actually, really since the beginning of April, if you think about it, when we first started to make new highs. We've just been kind of stuck in a range, trading sideways. We had a little bout of volatility as we approached the middle of May, and that kind of didn't really materialize into anything more than us just going back and retesting the moving averages, and then making our way right back to highs. I still remain skeptical that we have enough demand and enough buying pressure to push through these all-time highs. As you can see, yesterday we opened higher, and which is, by the way, it's a holiday shortened week, and so yesterday was the first day of the week, and as you can see, we opened up, as we tend to do on Mondays, with some buying, but it was quickly met by selling, and we faded most of the day, and we ended up with this red candle here. And as you can see, we kind of went right up to almost all-time highs, and then just faltered and came right back down. And today we have a bit of an inside day with a real narrow doji candle, showing a little bit of mixed signals between buyers and sellers, as they can't really figure out where we want to go next. And I think that's become the problem, is that there's a lot of demand, at least as far as the indices are concerned. I'm seeing a lot more selling pressure and a lot more effects of the supply that's overhead when I look at individual names. But when I look at the indices, they're holding up pretty well. However, despite the fact that there is enough demand to keep them from really falling below some critical technical levels, there isn't enough demand to be able to push us through these levels of supply that are just waiting above us. And we have not been able to push towards new highs. Now, this is not really anything out of the ordinary. This happens pretty much in any equity or any market environment. You tend to have stages of either strong moves up or down, followed by ranges of consolidation. And as you can see, if I take out my rectangle tool, that's all we've really been doing, is just trading in a rectangle as we try to figure out what's good value for the S&P 500. Like I said, this is normal. This happens pretty much with any equity, where you have buyers that consider a certain level as a good deal, and they consider the other level as a bad deal. And I think it's pretty clear in this case that a good deal, as far as the market is concerned, is right around 400, a little bit above it, and a bad deal is right above 420 as we hit the 422, 423 range. And so right now, the market considers the S&P 500 to be overpriced, over 420, but it considers it to be a deal anytime you start to get close to the 400 level. And that kind of makes sense, and that jives with what we've done, which is basically stair-step our way up throughout the year. And you can see the last time we had a range, the ceiling was just below 400. And so we've kind of flipped, where what was once considered a poor deal is now considered a good deal, as the price of the S&P 500 doesn't even reach that before people start to buy it, right? And so this is how things typically develop when you are watching a stock move, and nothing here is out of the ordinary. However, in the bigger scheme of things, we have a trend that has been kind of steady for a while now, and it's starting to get a little long in the tooth and starting to get a little bit overextended, and at a certain point, this is going to eventually resolve itself in more of a sideways environment. Once the buyers just don't really want to defend or support this trajectory anymore. And that's something that we've seen already happen on the NASDAQ. We've seen it happen on the Russell 2000, but we have not yet seen that on the Dow Jones and the S&P 500 as far as 2021 is concerned. And so we've been expecting this to happen, but as the market tends to want to do, it's been kind of pushing the envelope with this rally and continues to push it upwards and trying to confuse as many traders as it can. This is typical of market behavior. It's going to try to trick you into expecting one thing, and then it's going to give you the other thing in order to trap money and kind of take it away from you. And so, as I say pretty much every week, despite what you might expect or think the market's going to give you, the best you can really do is react to what it does actually give you. And so in this particular case, we have continued to do the same thing that we've been doing for the last month and a half. Actually, really, the last 3 or 4 months, if you really think about it. For those that follow me on Patreon.com, we've been trading pretty cautiously. We've been kind of outlining maybe 1 or 2 trade ideas a week that we have faith in, and being really picky about what triggers we want to, or what kind of criteria we want to meet before a trade is triggered. And that's because the market environment right now is not really conducive to good trades. Even though the market is at highs, we're seeing a lot of choppy price action, we're seeing a lot of false moves, and we're seeing a lot of rotation back and forth between different areas of the market. And that has made it a lot more difficult for a trader than maybe what we saw at the beginning of the year or the end of last year, where pretty much every stock went up together, and anybody that bought a stock was more likely than not going to be rewarded within a week or 2 weeks of that. That's not really the case right now. There's a lot of back and forth, and so what we're going to do is continue to do what we've been doing until the market conditions change, and that is going to be to just make sure that we are very picky about what kind of stocks we want to trade, and only look for the trading setups that give us the best chance of success, whether that be because of probability or whether that be because of risk reward, and making sure that we don't have any kind of ambiguous or vague trading scenarios where we're not really going to be able to have easy to make decisions. I think that's one of the keys that I try to focus on right now, is making sure any kind of trade I take, I'm looking for very easy to make decisions as far as when to enter, when to exit, when to take profits, so that I don't let my emotions kind of cloud it, particularly when the market is really just going back and forth. All right, so with that being said, let's take a closer look at the S&P 500 and try to gauge what levels are important in the short term and in the intermediate term. Like I said, we can already kind of highlight the price ceiling, right? And this is basically the top of what we can expect right now. If we can push through this, I guess we'll color this line green because this is kind of an important point in where we are right now. If we can break through these highs and start to push past that, well then this rectangle that I just drew recently, it'll be concluded, and it'll just be another one of a long series of stair steps as we make our way upwards and continue to follow this upwards trajectory on the market, and we start a new leg up in the rally. If we falter and fail here again, we're likely going to come back and test these moving averages, the 20 and probably the 50, and come back and test the bottom of the channel, right? So this is a very critical level, 422 and change. If we lose that, the 20 is so close to price that I imagine we lose that as well, and we come back and we test the 50. As you can see, we already had a round of testing the 20 and the 50. For those of you that are maybe new here, every time that you have, well, not every time, but very often when you have a stock that is trending as cleanly as the S&P 500 is doing right now, you use the 20 as kind of the initial support zone, and then eventually you'll come and test the 50. And usually when you test the 50, you come back and you bounce and you test the 20, and you kind of spend a little bit of time in between them. And then more often than not, it resolves in the same direction as the previous trend, which of course would be up. And that's what happened back here in February and March, and it's what just happened right now in May, where we had a nice strong trend. We tested the 20 and eventually lost it. We came and we tested the 50, and we chopped back and forth between the 20 and the 50, and then we kind of made our way up. Now, so far, The S&P 500 has not done a single thing wrong to invalidate this particular trend. You can see the moving averages. The 20 is still above the 50. Now the 20-day moving average is getting pretty flat, but that has happened before, and that happens when you come back and you test the 50. It's just a function of math. It's the way moving averages work, as they kind of lag behind price. And as you can see, price has turned sideways for quite a bit before that. Now, the key here is for price to stay above it and to break out. If that's the case, these moving averages are going to start turning right back up and are going to do the same exact thing that they did back here in the beginning of April, where you can see they kind of came close to meeting, then they curled up right back up and they spread out and they started a new leg up. And so we are at a pretty important inflection point where, as you can see, we are in the process of testing this ceiling twice. Could be the beginnings of a potential double top. Not quite what I would expect out of that pattern, considering the neckline is off. But a lot of traders will look at this and say, well, they'll only focus on the two tests at the top and assume that's the kind of pattern that's developing. And if that's the case, we would need to drop that and come down and lose these lows. And at that point, then that becomes a much more valid signal as far as bearish price action is concerned. So we've reached a critical point where either we break out or we fail, and if we fail, then, well, these moving averages are getting pretty close, and they're likely going to be violated as well. And if we start to lose these key areas, particularly the 50-day moving average, then we have to come back and test this 405, and if we lose that, which would likely be the case, then we head back down, we test this 397 to 398. And so if I'm looking at key areas in the market right now, the three areas in the S&P 500 that are critical are this 397 as far as strong support in the event of a much sharper correction that we've seen so far. To the upside, we've got 423, which needs to be broken in order to continue this rally. And then in between those would be the 50-day moving average, which I consider to be much more significant and much more important right now than the 20. And more important than even this trend line, which is really just kind of a visualization of the trend rather than really focused on supporting it with an intersection of candles. As you can see, it only really, this particular trend line that I've drawn really only crosses through about 3 or 4 points. It's more of a visualization, and it's really just running parallel to the top, which has become a much more clear representation of this trend. And so I would consider the 50-day to be a little bit more important. And then, like I said, if we lose the 50, we probably lose the trend line, and we head back, and we could probably test this 405, but the real critical test will be just below 400 as we hit the 397, 398 area. And so those are the points that I think mean the most as far as my interpretation of the price action is concerned, and will be the levels that I will be watching closely to see what ends up happening over the next week or two as we try to really just push through this range and extend this rally, which again I think is a scenario that probably won't happen, but if it does happen, well, then we have to be ready to follow upwards and continue to trade momentum upwards. If not, then we just need to be more patient and wait for where the support is going to be and where the floor is going to be and where we could go ahead and buy dips. As I've said before, when we do these Wednesday market streams, my goal is to analyze the market environment and to try to understand what kinds of trades work and what kind of trades don't work. Throughout a long rally like this, momentum works, right? But as we start to get into these rectangles, these consolidation ranges, more range-based strategies work, which means buying at the floor, selling at the ceiling, maybe even selling premium. And so we're, like I said, at an inflection point right now where we have momentum that is starting to not work, but at the same point we're not we're not in a very strong range-based environment where range-based trades are easy to trade either, which is why I've been pretty careful about my trades and being a lot more picky about them, is because we're kind of at a spot right now, and even from a larger perspective, you could look at it as a bullish and a bearish trend starting to meet up, where we're starting to maybe look like we're hitting a ceiling that we can't push through, and at the same time you have a long-term bullish trend that's still chugging upwards. When you have this conflict between two types of price actions, you tend to get more muddy or more choppy price action. And that's why it's becoming a little bit more difficult for traders to really navigate the waters right now. So we want to wait for a clear picture, and that might mean waiting for us to come back all the way to 397. It might mean waiting for us to break above this green line and then come back and retest it. But we will get a cleaner picture sooner or later, and that would make trading a little bit easier for us. Until then, like I said, we just need to be a little bit more picky about what we take. Now, if we look at the NASDAQ, you'll notice that we lost that on the NASDAQ a long time ago. The upwards trajectory, the top of that channel, and we came down and we shifted and we traded sideways, and we looked like we were even in the process of topping out. And it fooled traders into getting maybe more bearish than they should have, and we immediately came up and we hit the new highs. Now, again, we tested the top of that ceiling twice and failed and came down, and then again threatened a breakdown before we were kind of making our way back up. Now, you'll notice, unlike the S&P 500, the NASDAQ, the moving averages, are already sideways. They've been sideways for a while. They're already crossing back and forth between each other. And this is more indicative of a range-bound environment and more indicative of the type of environment that I consider us to be in, despite what the S&P 500 and the Dow Jones are doing. Underneath the surface, if you look at individual names, my watch list, I have a watch list of at least 50 to 100 names that I watch just on here, let alone the other hundreds of names that I scan through each day, looking for possible trades. I've noticed that a lot of the names in this market are going in opposite directions. There's a lot of tech names, there's a lot of growth names that are dropping, and then there's some smaller cap names, maybe some energy names, maybe some financial names that are going up. And this is a broader function of the rotation that continues to come into play here between stocks that did well in 2020 and stocks that theoretically should be doing well in 2021 as we get more and more of our population vaccinated. And while that's one of the larger macro themes that is going on with the rotation, it's not the only one. There are some smaller ones that are at play as well, and that's caused this market, like I said, to be, again, a mix of different types of environments that are coming in at the same time. And that's why, like I said, we have this really choppy price action, because we have all these different conflicting trends that are kind of crossing together and pulling in opposite directions. And so, from a bigger picture, one of the trends we're seeing is that the NASDAQ and the tech names are struggling. And you can see that pretty clearly, like I said, just when we go from the S&P 500, which is still in a clear uptrend, to the NASDAQ that is clearly not in an uptrend anymore and is in more of a sideways range. And until, in my mind, until we see the NASDAQ resolve higher, considering the FANG stocks all reside in here, and they are the ones that tend to lead the market upwards, until they can get their act together, I think we're not going to see a very strong rally in the market. So even if we do see new highs on the S&P 500 and in the Dow Jones, it could just be that we see them sporadically on those two indices, and then we see the NASDAQ come up and test highs, and then as it starts to falter, we see the price action falter across the board. So if you are really looking for a strong rally compared to what we saw last year, we need to see the NASDAQ kind of go and join it. If it doesn't, then we can assume that it's really more of the same price action we're seeing now, which means certain areas of the market might rally while other areas of the market might falter. And if that's the case, like I said, it becomes a little bit harder to trade, and it becomes a situation where, as a trader, you need to do your work and really dig through and try to figure out where these areas of strength are and what they are. And so, for those maybe wondering, one of the things I like to do is come on here to FinViz, and I like to look at different areas of it. Here you can see right away, you can see the heat map. You can see today there's pretty good chunks of green across the board. You've got some red here, you've got the consumer cyclicals red, you've got industrials red, but you got the financials sort of green, and tech is actually kind of green today. But you can go either into the screener, or you can go to your maps, and you can take a look at the maps, and you can look at it from different perspectives, from one day to what it's done over the week, to what it's done over the month, right? And it gives you a better picture of what's really doing well and what's not. Or you could go to your groups, and again, it's the same information but in a different picture. and you can get a good idea. You can see energy, and as we move forward and we take a look at oil, you'll understand why energy is doing so well. But you can get a good picture of what's going on here, and then from there you go to your screener and you just start to look through different sectors or through different industries and get a better picture of what it is that you want to look for. And so those are some good ways to really dig in and try to figure out where the money's rotating into and out of, and try to stay ahead of the trend. Like I said, this is not a good environment for easy trading, and so you really need to do your homework and you really need to dig in and work at it if you want to find successful trades at this time. And so the Nasdaq, like I said before, it's lagging. It's doing it's doing its own thing, and while it's been relatively weak compared to the S&P 500 and the Dow Jones, it actually hasn't done too poorly as far as just looking at an equity that's range bound and is still trying to work its way towards starting a new trend. As often happens when you have a strong trend, you'll eventually lose it, and this is often the first drop like this is usually interpreted as a market top or as a top in the equity, and that's usually not the case at all. It's one of these situations where the equity needed to push the envelope down and to figure out where buyers were willing to defend. And typically when that happens, you turn around and you either resume the uptrend or you maintain a neutral trend, and you basically develop an either accumulation or distribution phase where you just go sideways for a while, and then eventually it resolves. And much like the chop between the 20 and the 50, it usually resolves in the previous direction, right? And so there's still a pretty good chance that the Nasdaq is going to resolve to the upside eventually and start to make its way upwards. Like I said, it's been trading sideways now since about February, and it could be getting close to trying to break out, or it could be entering a phase where it trades sideways for several months, if not years, right? If we come back and we take a look at a weekly chart, we take a look at what the Nasdaq has done, you can see if you look at it from the bigger picture that there's been a long, pretty strong rally now since the crash that we had last year at the start of the coronavirus pandemic, and we've had just a really strong trend, and we really haven't traded sideways for very long. And if you take a look, before this massive rally that began at the end of 2019, we traded sideways for 2.5 years, from the beginning of 2018 all the way through most of 2019, and then eventually we're able to break out, and that's what started this rally, which was just briefly interrupted by the coronavirus. And so it could be a situation where we need to trade sideways for a whole year, or maybe even 2 years. And so this could just be the beginning of that, or it could just be a 4-month or 5-month consolidation, and we just continue this rally upwards. And we don't know. Anyone that tells you they do know really doesn't know what they're talking about. So the best we could do is, like I said, is try to prepare ourselves for these potential scenarios and play them as they play out. And so, like I said, with the Nasdaq, we haven't seen anything really bad, really negative. This was not a good move here, where we lost the 324 area, but you can see we had a nice little double bottom. We came back up, we got above the moving averages, and right now the 20 is starting to curl up to meet price. In order for this to continue, it needs to break above these recent highs around 335 and make its way back up towards the 340 range. And for that to happen, we'll likely see the S&P 500 break to new highs. And then that would mean that the Nasdaq can kind of play catch up and come up and test the 340 area. And I suspect that when we do test the 340, it'll likely stall out, and then we continue to trade sideways. But that's just one of the things, the potential scenarios that could play out, and we just have to wait to see how it happens. So if we're looking at the key levels on the NASDAQ and how we want to go ahead and try to gauge what the market is doing, well, this level around 342 is very critical. The 335 that we are trying to break through, of course, is important. And then we have this range here. We've got this trend line around 330, which is converging with the 20 and the 50, and that's pretty good intermediate support. If we lose that support, we're going to head right back down, probably lose 323 and come back into this range here. So I would say watch 316 as very critical support and a good buy the dip area, assuming the markets don't enter full-fledged correction mode. Short-term support should be right around 328, and then long-term, or well, intermediate-term resistance should be about 342, and long-term resistance. And anything above that means all systems are go, and we should begin to start getting more aggressive about trading. I think a lot would depend on how that breakout occurs. If it happens in one candle, then maybe I'd be a little bit scared of failure. But if we kind of build up momentum and then break through there, or we see strong momentum in the other indices, then I would say that's a good time to change our stance and to become a lot more aggressive about trading. So that would be the key level, really, to get aggressive. If not, then we have to assume the NASDAQ is just trading sideways, and it's just kind of ranging back and forth between the floor and the ceiling of its short-term price action. Now, going right back to the opposite picture, we have the Dow Jones, which again is not really trading sideways, at least in the intermediate term. In the short term, it still is. We can use this rectangle and identify what it's doing, and it's just trading sideways, just like the S&P 500. However, this sideways consolidation is still within the larger context of a much longer rally, and that rally has not been broken yet. And so again, just like the S&P 500, we have a little bit of a conflict here between the short to intermediate term, where traders are getting a little bit more bearish, and the longer term, where traders are still pretty bullish. And that's what's led to a lot of this choppy price action back and forth. And until we have a resolution and we have a win from one side or the other, we will continue to see that. Now, if the bulls win and we break out, well then, like I said, we're going to get cleaner price action, and it'll probably be reflected across the board, even on the NASDAQ and IWM, which will kind of run up and try to test their previous highs as the S&P and the Dow Jones explore new highs. If they falter and we head back and test the bottom of this range, well, we'll also see the NASDAQ and IWM head down and probably break below their respective ranges. So, it's all tied together, even if it doesn't look like it. And really the differences right now are as far as where they stand compared to relative price levels. One thing to note is that while we faded most of the indices yesterday, the Dow Jones did hold up pretty well, and did try to make its way up towards that shooting star from a few weeks ago. So again, this is an area of relative strength, and it's one of the pockets of the market that has really been able to behave well despite what the market has been doing recently, which, like I said, it doesn't look negative, but it's been pretty difficult to trade because there's been a lot of sporadic selling, and particularly when you go under the surface and you look at a lot of individual names, especially a lot of the names that we've traded over the last year and a half. But the Dow Jones has been able to shrug that off for the most part, and is doing what it's supposed to do. It did the whole dance between the 20 and the 50, resolved to the upside, broke through this short-term resistance, and again is really just testing all-time highs. A lot of what I said with the S&P 500 is going to apply here as well. So I'm not going to add too much more other than to say that we have the same area that it needs to break. Unfortunately, with this one, it's not that clean because you have the wick that's important. But basically, we need to break above this area between 349 and 350. If we break above that, there's a good chance that we see a new rally in the markets, and trading will be a little bit easier for us. If we fall below that, we're going to probably come down and test the 50. The 50 is going to be the critical level, and then below that, this trend line. And so those will be the three key areas that we need to watch in the Dow Jones. All right, so lastly, we have IWM in the small caps, and much like the NASDAQ, we have an index that's already been trading sideways for several months now. It's kind of off the all-time highs, and really just consolidating after a strong rally. And so this again kind of shows us the picture of what's really going on in the markets, where certain areas are doing well and certain areas are not. Now, the areas that are not doing well, they're not doing terrible. If you look at this in a vacuum, this is still a decently bullish chart. You had a strong rally, and then when it sold off, it didn't really fall too far down. It just kind of broke the uptrend, took a little bit of time to develop a floor, and then has just been trading sideways and building up momentum to try to break out. So far, IW hasn't really done anything negative. It's only negative when you look at it compared to the S&P 500 and the Dow Jones. If you just if you're just looking at this as a stock to trade, nothing here is really indicative of a stock that has done anything wrong. And so the question becomes, has it done enough consolidating to break out? If we take a look at it, you have the move up, come down, test support, move up, test support, come up again. Now, the key problem, the only issue I really have here is when we lost this upwards trend line, right? Because up to then, this was a perfectly bullish accumulation phase, right? Where you come up, you test, and then the last attempt to break out, you kind of do it in a much shallower manner. But you can see it fell short of really testing resistance, and then it broke this upwards momentum and it came down. It tried to continue it again, and it was able to break through at least here, right? But here's where we're, again, at a kind of a critical inflection point where if we cannot break above this 230 area, we're going to head down, and we're going to probably lose the moving averages, this trend line, and we're going to head back and test 207. There are only so many times you could try to climb through resistance and fail without there being consequences on the other end. And if we can't break through these levels multiple times, then eventually the buyers are going to cave in and the sellers are going to get control, and we're going to head all the way back down and really start to test the bottom. And so that's going to be kind of important right now, is we're attempting to break through this zone again. If we fail again, I doubt we just do another one of these little triangles. I think we're just going to come all the way back down and test lower. Now, if we do break through them, then we're going to come up and test all the way up to all-time highs, which is about 5 or 6 points away. And then we'll see what happens when we do that, whether we stall out or not. But if we stall out, if we hit 234 and stall out, that's not nearly as bearish as stalling out where we are right now. I think if we stall out where we are right now and head right back down, then we're likely to head back through the moving averages. So that's going to be important to watch as well. So if you look at the four indices together, we have, like I said, a little bit of a mixed bag. We have two indices that are looking pretty bullish as they try to break through new highs, and we have two indices that are in the middle of some broad consolidation ranges and not really sure where they want to go next. Now, despite the fact that what I'm saying maybe sounds a little bit bearish, overall, none of these charts really have bearish patterns in them. They're all decently bullish patterns, and there's a pretty decent chance that we kind of just keep chugging along and break out. If we don't break out, again, I don't think it's bearish. I think it's just more indicative of a range-bound environment, and one that I've anticipated is really going to continue to develop as we move forward this year. We've kind of hit that sell and may go away area of the market where we're heading into the late spring, early summer, which is typically not a point of the year that's conducive to strong rallies in the market. And while that cyclical pattern has not really mattered too much over the last several years, as we've been in an environment with so much stimulus and liquidity that it's kind of ignored the normal cyclical patterns, it still kind of plays out. Even if we go back and we take a look at last year, we'll use the S&P 500 for this rather than looking at IWM. Even if you look at last year, right, we had a little bit of a sideways move as we headed into the summer, and then we eventually broke out. And again, it wasn't really until the holidays that we really broke out, which is typically how things happen in a cyclical manner. But we still had a pretty strong rally, and a lot of that, again, ignored a lot of the cyclical patterns that tend to develop during the year. And so the market, generally speaking, has kind of ignored that, but this could be one of those years where it kind of comes into play a little bit more. And if that's the case, then we might see more of this sideways action as it creeps up into the NASDAQ into the S&P 500 and the Dow. And so that's the four indices as far as my take on them is concerned. Like I said, we are still at a pretty decent point of inflection where we could start to rally again, or we could become a lot more entrenched in this sideways environment. And until we see a clear picture, we need to just continue to kind of be cautious, take our time, and make sure that we like the trades we're taking, and not get overly greedy. Like I said, I think last year, towards the end of the year, beginning of this year, it made sense and it paid to be a little bit more aggressive with our trades and to take more trades. Right now, it makes more sense to take less trades and to be more picky about what we want to take. Let's take a quick look at the US dollar. It looked like it was getting set up for a bounce last week, and as you can see, it has not been able to materialize yet. It hasn't broken down, and actually we are reaching a possible inflection point on here as well. As the dollar kind of deals with these two, and again, these trend lines really identify just conflicting trends, right? We've got a bearish trend and we've got a sort of bullish trend or neutral trend, and they're coming into conflict, and one side will win out. Whatever side wins out, the price action will either break through that or it'll break down. And right now, we're right in the middle of it. We're getting pretty close to a point where something has to be done as we approach this apex where the two trend lines kind of intersect. Probably we're still set up for a bounce here in the dollar. And if that happens, that might lead to some more bearish action across the board. But until we see that, again, we just have to kind of watch and see how it develops. Now, let's see if we can get a little bit more clarity on what the US dollar is doing by looking at some individual currency crosses. The Euro US dollar, this is really just a mirror image of what we just saw. Right, we've got that triangle, we've got the dollar. Now this is going to be inverse, of course, where up is good for the euro and down is good for the dollar. But you can see the same scenario where the dollar is trying to bottom out as the euro tries to break out to new highs. And we've got that same trend, right, where we've got the short-term sort of bullish for the dollar and then bearish for the dollar as they kind of come in and kind of fight. And we're nearing the apex of that, and one way or the other will decide what happens next. Whether the euro, if the euro rallies, then the dollar will break down, obviously. Now, if we look at the US dollar versus the yen, we see a little bit of a different picture here. The dollar actually was kind of bullish against it. We pointed this out last week, and this ended up being a good trading opportunity for anyone that's into trading forex pairs, and was able to get a move off of this. And then finally, the last one we were looking at was the US Canadian, and this one actually surprisingly held up considering what happened. So we were looking at this as a potential trading opportunity as well, but a lot of this was going to be dictated by what oil did. And if oil broke out, or if it was not going to bode well for this, and if oil broke down, then this would have been a strong breakout. And unfortunately for the US Canadian cross, if you're looking at it as far as US dollar terms are concerned, oil did break out. Oil broke out very strongly and was able to break through to new highs. And so this depressed the value of the US versus the Canadian, but this is part of the reason why we're seeing energy across. You know, when we were looking at the stock screener earlier, you can see energy, right? 1 week, 1 month, 1 day. Well, that's because of this. That's because of what oil has done, right? And why oil continues to rally. And so energy has been a sector that's important to watch. And so for those of you that watch these videos and maybe you start to get a little bored when we start to get into something like the oil and gold and silver, keep in mind this is still, you know, these are important areas to watch. Looking at to see what energy does is important for us to figure out what's going to be trading well and what's not going to be trading well. And you know, anyone that watches this would have known to kind of keep an eye on oil names and to trade energy as it kind of bounces off of this. Now, where can oil go from here? Well, obviously, the sky's kind of the limit as we're breaking to new highs. I suspect that as we hit the $70, we're probably going to stall out again. But this upward trajectory is intact. And I think, like I've said quite a bit recently, this is reflective of a market that is expecting energy demand to continue as we continue to get more and more vaccinated and open up our economy more and more. Now, I did see some of the OPEC countries are planning on ramping up production again, and that could eventually put some supply that could depress the price of oil once it hits its whatever the next ceiling is going to be. But you know, those kinds of scenarios play out a little bit slower than what we see on the price action. So for now, we're just going to read the candles and follow what they do. Now, the last commodities we want to look at are gold and silver, and as you can see, gold has been rallying pretty strongly, and with the dollar not really being able to bounce, gold has crept up a bit. It's getting to the point now where this is not really a bullish pattern. You don't normally want to see these little channels under consolidation ranges, as it's kind of indicative of a little bit of a beginning of a squeeze. It could squeeze further, but what often happens in this is you get a sharp pullback, and then a pullback back to the 20-day moving average and back to this 174.50 would actually be a pretty decent buying opportunity, particularly if we start to see the dollar lose ground again. Then the last one we want to look at is silver. And silver, a little bit more of a sustainable consolidation range, but the same basic idea. Could do that here. We'll just put it up at the top of the range, and then we'll do one here. So you can see it's just consolidating as it's made its way up. Not quite as simple to trade as GLD right now. You can see it's a little bit of a sloppier chart. There is kind of a longer term channel that's developed here. Right, and so we could, if that's going to be the case, if that's going to hold, then this might be a buying opportunity. But consider what I'm seeing in gold and in the U.S. dollar, there could be a chance that this eventually breaks and we just consolidate sideways before we make our next move up. But it's something to watch and see how it plays out from here to next week. Overall, I still prefer cryptocurrencies over gold and silver. However, they are becoming more appealing as they finally start to break some of these long-term downtrends that have been in place. And then finally, we'll look at Bitcoin and Ethereum. And then, if anyone in here has a chart request, feel free to type it in. Love to see what you guys are looking at and see what's been kind of shaken out. As you can see with Bitcoin, it is still trying to stabilize after this big correction that it had, going from 60 down to it actually got cut in half for a second, but really going from 60 to about 35 to 40. You can see a lot of volume kicking in as it started to really hit a critical level here, and while it broke the initial downtrend, it hasn't really been able to make its way back up, and as you can see, it's going to start to contend with its moving averages. Overall, this is not really a bullish chart yet. I think that this is a pretty decent potential bottom. However, there is a chance that it fails, and if it does fail, we could head down into again, back to 30 and slightly below it as we test the 29, 28 range. However, if we can get back above, say, the 20-day moving average first and then the 200, then I think that this will be a good bottom, and we'll eventually make our way back up into the 50s and possibly 60s. Now, if we look at Ethereum, relatively speaking, it's been a much more bullish chart. It didn't really lose. It lost a lot of value as well, from 42 all the way down to 19 or 20. So it basically got cut in half as well. But from the perspective of support and resistance, it didn't break below its base. It just came back and retested what was the previous sort of price ceiling. You can actually draw a pretty clean trend line here. And you can see we had this triangle, we broke out, we consolidated for a bit, then we broke out, retested, and then really took off. And we've just come back and retested that. So nothing really negative as far as the technical analysis is concerned, but obviously it's a pretty big correction percentage-wise. But that's the way cryptos move, right? It's also been a pretty big bounce percentage-wise as well. And every single day you can get 4, 5, 6, 10% on a lot of these because of just the way they fluctuate and the volatility. Overall, this is again a pattern that's kind of neutral. We have a pretty good developing bottom, but it really hasn't been able to push past what I would consider a full bottom. I don't know what happened here. I lost my trend line. This is the point that we would need to break in order to start making our way back up towards the threes and beyond. Relatively speaking, it's more bullish than Bitcoin, but we're not out of the woods yet here. And there's a chance that we have to come back down and test the 2100 and possibly below it. If not, then we could break out. However, still think that there are going to be some good trading opportunities here as we come back and test the 2100 or as we break out above this. So I'm still kind of watching these closely, and I'm still trading some of the smaller currencies that have been able to give us better moves. Stuff like Binance, which is starting to break out and kind of lead the way upwards beyond these. And then, of course, something like Matic, which I've been in for a while, which, as you can see, relatively speaking, has held up well. Or something like Doge, which is starting to rebound again compared to where it was recently. You can see starting to break out and had a really nice move since yesterday afternoon. So that's what I have. That's what I've been watching. If anyone has a chart request, like I said, feel free to type it in. If not, we can kind of call it a day. We're pretty close to the hour already as it is. We were watching, for those of you that follow me on Patreon, we were watching IIPR today, or this week. It's doing a good job of kind of breaking a downtrend. And then we have ASLE, which is starting to work for us as well. And again, you can see what I've been looking for as far as making sure we have good risk reward and that we have clean setups that are easy to identify. And whether these materialize or whether they turn into good trades is still it's still not decided, but the important thing right now is making sure that we have trades that are easy to navigate and we don't have to make too many difficult decisions. Alright, well, I guess that covers it for today. If anyone in here has a chart request they want to ask me throughout the week, you can always ask me on Twitter. Like I said, just follow me at StockDarts on Twitter. I'll be more than happy to answer your questions on there. Or visit me at patreon.com/StockDarts, where, like I said, you can visit and watch my thought process through the blog or the recaps of these videos as I go ahead and repost them. Have a good rest of this week, and we'll meet again next Wednesday.